Chapter 1 deals with the overview of financial management. When we're talking about financial management, it's important to understand the fundamental concepts related to the overarching issues of the chapter. And so we see here the different business forms, creating value for investors, the conflicts which occur between stockholders and managers and stockholders and debt holders, and making sure that the interests of the society and shareholders are balanced. Within an organization, the chief financial officer usually reports directly to the chief executive officer, and as we see here, there are multiple functions which the CFO is responsible for. Accounting, treasury, which is cash management, credit, extending credit to customers, legal, capital budgeting, and investor relations. Within the forms of the business, we have a proprietorship, a partnership, and a corporation. Most of what we'll be talking about in this class relates to the corporate form, and so that is where we will be spending most of our time. When we're talking about proprietorships and partnerships, there are advantages to those in that they're easy to form, there's fewer regulations, and there is no corporate income tax. It's all passed through to the actual owners. The problem with this is that it's hard to raise capital, and that's one of the things that we'll see here in the corporate form. Also, there is unlimited liability for both proprietorships and partnerships, and so the corporate form corporations allow for legal protection and is able to extend beyond the life of a single individual. So we see here the advantages of the corporation: unlimited life, easy transfer of ownership, meaning that you can sell shares. And this, some is easier than others, depending on if you're a publicly traded company or not. Limited liability, ease in raising capital, assuming you're creditworthy. Disadvantages: double taxation, meaning that you are taxed at the corporate income level and then at the personal income level for shareholders. And then there's significant cost and setup and registration with various governmental entities. One thing that we want to understand is the value of the company, or the intrinsic value. And so when we're talking about at equilibrium, where all things are perfect, the stock price should equal the intrinsic value of the company. Now, this is not always the case, and so being able to identify the differences is an important part of financial management. So intrinsic value, it's a long-run concept, and so we're trying to identify not in the immediate future or even in the present, but in the long term, is there the appropriate value for the company? So let's look at those things which determine this value. We see here we have management actions, the economic environment, taxes, political climate. All of these factor into what the price or the value should be. We see here, as it pertains to these issues, we can start to model some of these values. We see with investor cash flows, understanding operational cash flows is an important part of this, being able to quantify risk or true risk, understanding the perceived cash flows. Perceived cash flows is what is to be expected in the future, and then also perceived risk. What is real risk versus actual risk? All of these coalesce into this market equilibrium, where our intrinsic value equals our stock price. There are a variety of conflicts which occur between the various stakeholders. Managers are going to act according to their own best interests. This is one of the fundamental assumptions of human nature. Because of this, managers may act in ways that benefit them at the expense of shareholders. And so ways in which we try to mitigate that. We try to create compensation packages which encourage managers to act in the best interest of the shareholders. This may be by making them a shareholder themselves through stock options or just awarding stock to them. Also, we have shareholders can intervene, especially with the CEO, because the CEO is directly accountable to the shareholders and can be fired Also, shareholders, if they decide that management is truly horrible, can seek another company to buy out the company and essentially exchange shares for that. And then that way you eliminate all of the executive management team. Stockholders and debt holders, this is the balance between the concept that we'll know to be as capital structure. And this is where stockholders want more risk because higher risk necessitates a higher return. Bondholders want limited risk because they have their return already specified in the initial contract, and so they're not expecting anything beyond that, and so they want safety to make sure that their rate of return is going to be paid. Being able to balance all of this, at the end of the day, one of the fundamental assumptions of financial management is to maximize shareholder wealth. Now, this is not said in a vacuum. There are ethical assumptions that should be built into this. We should not exploit others to create this shareholder wealth maximization. We should not cheat. We should not lie. We should not do those things which would be to the detriment of others, but creating true value, maximizing the company, and creating the best product or service for the market is appropriate. And this is the ways in which we can maximize that value. And so this is chapter 1.